Hello again, everyone, and thank you for staying through to the very end of Bloomberg Wealth. Delighted to see you all. This panel is a bit different. This is a panel of investors. We haven't done this yet today. And as you've probably seen, it's a panel about investing in private markets. I have brought you subject matter experts. As you just heard, Suyi Kim is an overseas private equity at CPP IB. Raja here is a managing director in private credit at Apollo, and Isabelle does private credit, does private equity, does real estate, does infrastructure, overseeing alternatives at AXA Investment Management. And so they will bring you, the investors among you, insights from fellow investors. And since it is a conversation about private assets, why not begin with a poll, everyone? Get out your phones. We'll bring up the QR code once again. And the poll itself, how much of your investment portfolio should be in private assets? Is the right answer A, 10%, B, 25%, C, a third, or D, half of your portfolio? Folks, please register your votes, and after an initial round of questioning here on the panel, we shall reveal the results. I thought a good way for us to begin this discussion would be with an overview of the asset classes our panelists are experts in. And so, Suyi, I'm going to ask you to begin by sharing your perspective on what's happening right now in private equity. As many people in our audience surely know, private equity is in a bit of a tricky spot. Exits are challenging. There are maturities coming due on loans that were originated at much lower rates. Leverage is harder to get, and that's just the beginning of what private equity is dealing with. As an investor in private equity, Suyi, what's it like?
Thank you, Erik, and thanks for having me. It's an honor to be here. I've been in private equity industry now almost 25 years. Yeah. This is an industry that has grown significantly and dramatically over that time period. And this is an industry I am still passionate about for a couple of reasons. Somebody said the private equity industry is a governance arbitrage. We all know that the performance of the businesses very much hinges upon what the governance that you have for the businesses. Private equity, buyout strategy in particular, has strong governance in the company. It's an owner who's driven to make 2.5 to 3 times money in 5 years, and they deliver it. Yeah. Private equity is also, as an investor, is an asset class that if you do more work, if you do more diligence, you can make better informed decisions. Hence, you increase your chances of making higher returns. So I call this as honest asset class. I tell our team, the more work you do, have more conviction, it's likely that you deliver. Yeah. As Erik mentioned, I run global private equity business at CPP Investments. We have currently about 156 billion Canadian dollars of private equity assets underground. That's about 120 billion US dollars. That makes us one of the largest, if not the largest, private equity investor in the world. Over the last 10 years, we have generated more than 15% net return. That's after all the expenses, all the allocated costs, as you may know. So this is an asset class that performed for us long-term in a very in a stable and high-performing and beating the public market equity returns that we have seen over the period as well. Yes, as Erik mentioned, the industry is going through some adjustment. Over the last 2 years, the activity has really slowed down. As we all know, 2022, with the inflation, rate went up, rate hikes, and the people, buyers and sellers, had a different views about the valuation of the assets that they own. Sellers did not want to sell. They didn't want to sell it at a discount to the carrying value of their assets. Buyers thought that with the new rate environment, they didn't want to pay the multiple that they saw the years before. What I have seen from my own portfolio as well as in the industry is that we have seen the underlying assets growing at a very healthy pace. We have seen for the last 2 years across all my asset portfolios, top line and bottom line growing double digits. Particularly strong growth for our U.S. investments, which is more than 60% of the entire private equity market, and same for my overall portfolio too. So over the last 2 years, I would say that the price discovery, I feel like that discovery has been coming to close to an end. The price expectation gap has been narrowed, so I'm seeing the activities picking up. Erik, you're also right that people call the exit drought has been there. Yeah? given this buyer and seller valuation gaps, activity has not been happening. IPO market was on hold. I do also see the signs of that opening up as well. In our own portfolio, just last month, we signed an agreement to sell one of our assets called Dorna Entertainment, which is a MotoGP, it's a motorcycle racing company, to sell it to Formula One, Liberty Media. That was a strategic exit. We also, 2 weeks ago, IPO one of our portfolio company called Viking Cruise, which is a river cruise company. And that was one of the biggest IPO in this market, and it's trading really well as well. So I do see signs of that opening up too. One last point, there's another wave of the exits private equity industry has created, and that we are one of the pioneers, which is secondaries. And secondaries has been firmly, I think, getting in their position of providing liquidity to the LPs as well as GPs in the private equity industry.
One quick question for you, Suyi, before we move on. Private equity isn't that old an industry. It dates back to the bootstrapping of KKR in the mid-'70s. And it's gone through several eras. We are obviously long past the days when there were so many inefficiencies in the market that without very much effort, private equity managers could crank out 30 and 40% annualized returns. But if you look at what you're doing and where you think the industry is headed, particularly with interest rates where they are and where they're likely to be, are the days ahead for private equity better or worse, perhaps, than what we experienced in the aberrant years of ultra-low rates between the GFC and the pandemic?
Yeah, you're right. That with a very ultra-low rates, private equity had a great time in compounding and getting multiple expansions. So there are reports out there talking about the returns. Half of them came from the multiple expansions. But it differs depending on what type of investors and which managers that you're looking at, what type of deals you're looking at, right? Some multiple expansions without the rates decrease and ultra low rates, you can still justify. If the company grows their revenue from 3 times and 4 times, and then you have a better position in the market, can you justify higher multiples? I do think yes. The bad news is that going forward, for you to be able to do that and without less reliance on the multiples, the work that you need to do to create the value of the assets that you own will be harder work. You just need to put into the harder work to get to the probably similar result, or getting overall industry, getting to that result will be hard, and it will be more differentiation between people who are really putting a lot of work to do the value creation versus people who in the past is relying on some great macro tailwind.
Raja, it's your turn to talk about private credit. There is discussion, shall we say, in some corners of financial markets that private credit is in a bubble. Heavens. Too much capital chasing too few opportunities, documents getting looser, and some shenanigans going on, the beginnings of what appears to be creditor-on-creditor violence in private credit, which wasn't supposed to happen. So tell us, what's going on?
Well, thanks, Erik, and it's a real pleasure to be here, and thanks for your time. I think the way to answer Erik's question is to really point out that there was one missing answer in the responses you were given. It should have been the fifth option, 90% of your portfolio in private assets. Jokes aside, I think before I start, for us at Apollo, today we manage about $450 billion in dedicated private credit assets. And most of that actually is geared towards higher quality investment grade, senior credit. And we ask ourselves daily the same question, and perhaps to you as well, is that why should we have $1 of a public market instrument in our portfolio? Do you really need to own one? And if you go back and you answer the question by saying that, well, public markets did serve a very important part of our portfolio allocation. It served as a good beta. It served as a good means of liquidity. But it had a lot of tailwinds that we have seen over the last 10, 15 years. A lot of that is unwinding or has unwinded, and we may not see that in the future. So what does the private markets really do? It's really become a home of massive amounts of liquidity that have gone from various aspects of our markets, and that has become a home. And that also leads to the fact that there's no real price discovery. So as an alternative, the way we answer the question is that alternative credits, alternative assets, alternative private credit is probably one of the few areas where you can actually generate alpha. And you can do that by actual underwriting of a certain asset or asset class and you can generate alpha. Now, we don't think that's the possibility of that in the public markets exists today. As I said, it's really has become a home for liquidity, and you really can't control your purchase price. As one example, S&P 500 today trades at 23 times. Dividend yield less than 4%, you have inflation 5-6%, and you have interest rates at around 5%. Now, the question is that, for you to go into that, at today's price, that purchase price matters. And what we can do in alternative and private credit is that we can be patient and we can source assets and we can underwrite to generate a very healthy return. Now, as I mentioned, of our $450 billion, we are mostly invested in the senior part of the capital structure, and we chose to be part of senior credit. And there's a reason for it. If you go back in history, private credit and where we are today really came out of a few factors. Really came from debanking in the US, which really saw the brunt post-GFC. You've seen it in Europe. Asia, it's much less. Asia, it's not the regulators that are telling banks to get out, but companies are requiring more sophisticated financings that the bank market can't address today. So if you think about the LBO market, a $5 trillion market, banks were told to get out. And banks are underwriting companies, LBOs at 6 times debt to EBITDA or cash flow metric, and spreads of 400. Now that's a great market to be. For us, we can generate assets in the low teens, staying at the top of the capital structure, and we can actually control our exit through those instruments. Now, secondly, a lot of the banks have gone out of very asset-intensive operations business. Think about trade finance. We bought BNP's trade finance a few years back, and that has given us the power to originate a lot of the trade finance loans, to a lot of middle market and large corporates. Third, we bought Credit Suisse securitized business called Atlas. That was last year. And that's really an investment-grade warehouse for ABS products. So all of these opportunities that were sitting on banks' balance sheets really are private assets that have come out to folks like us or others in the private credit market, where we can generate investment-grade instruments at high single digits and also secured lending in the low teens. And my final point is that why I feel optimistic about private credit going forward, despite all of the bubbles, and I'll come to that in a second, is that you have Basel III coming. And Basel III is going to have additional capital standards for banks, especially in securitized product. Asset-backed securities, you talk about aircraft leasing, lending to consumers, lending to autos. That is a $20 trillion market, and we haven't even touched the surface. So that just tells you that today, while private credit on paper, people say it's between $1.5 to $2 trillion, you're talking about another $20 trillion of possible assets that sat on banks' balance sheets that is going to come. So, finally, I think the most important thing is that purchase price matters, and it'll matter more in 2024 because we expect some managers to make mistakes. You're coming in and buying assets at the top of the market, whether it be equity or real estates, and even for private credit. There's going to be safe alternative private credit, there's going to be a risky part. And you just got to make sure that you allocate your portfolio to have the right balance.
Raja, very quickly, at least in the U.S. market, where private credit arguably originated, it is mostly, and you touched on this, LBO financing. I think that that's something that many people don't actually realize, that 95% of the loans that are originated are there to finance leverage buyouts. Is that the same here in Asia, or are disintermediating banks in different ways?
So I think that's a very good question. Banks, obviously, that was banks' bread and butter for a long time. And to just give you one example, in the U.S., 90% of all corporates that have more than 100 million in revenues are actually private companies. So for companies to stay public, the incentive of that has come down a lot because private companies can now access capital that they would go to the banks, right? So that disintermediation has really seen kind of a large proportion of that in the US, and we are seeing in Europe. Now, as I mentioned, in Asia, you do have sponsored activity, you do have LBO financings, but clearly, deal activity has been low in the last few years. But nonetheless, I think what has happened in Asia is that a lot of the domestic capital markets have become increasingly sophisticated. Hence, corporates are looking for much more sophisticated solutions that banks either can't provide, And that's where private credit can come in. And here we can really do large deals, and especially in Asia, people talk about that, well, the deal sizes are small. You can do large deals in Asia. And as one example, Erik, just a few months back, we did a large transaction for Panasonic. We actually carved out one of their businesses that made automotive cockpit systems, and we structured a private credit wrap around it. So I think those types of opportunities are going to be what we see here. It's not that banks are leaving or being told by regulators to exit, but it's really that the sophistication of the capital markets and borrowers here are increasing at a rapid pace.
Isabelle, before we turn to you, let's reveal our poll results. Everybody, remember it was how much of your investment portfolio should be in private assets, and the winner is 25%, but only by a hair. Some of you think, a good number of you think it should be a third, and as we go down, it gets, as you can see, 10%, a quarter of the audience. Very few of you think you should be dedicating 50%. Isabelle, I'm not sure whether that's good or bad news for you, I suppose, in some respects.
My answer would have been 1/3.
A third.
So I think I share the same views as most of the audience. So, yeah.
You have a broader overview of private assets in your role at AXA Investment Management, private equity, private credit, as I mentioned, and you could touch on those, but also please share with us some perspective on real estate and infrastructure.
So yes, private asset globally, I think for most of the investors we talk to, yes, the target is around 1/3, and it's a balance and a mix of private equity, real estate, infrastructure, private debt. But the way we look at all those asset classes is more looking at the underlying trends, what are our convictions on the market that will drive our investments. So just to echo a little bit what has been said, and notably on private credit about the bubble. I'm not sure there is a bubble, because when you look at the dry powder available for private credit, it's below what is needed by the dry powder available for private equity. So we have still a mismatch. Having said that, you have some capacity from the bank. The CLO market was closed last year, so more capital has been and more transactions have been done with private debt. The CLO market reopening, it will rebalance and readjust. That's the way the markets are working. But to come back on the way we are looking at all those asset classes, we are driven by convictions, by underlying trends. So, for example, bank disintermediation. We were talking about credit, that's a big one. And of course, this drives the capability to generate returns, notably on direct lending, as I've said, because there is some translation between the BSL market and the direct lending market. But it also offers a lot of opportunity, bank disintermediation, notably on, for example, the strategies where we can access to bank portfolio and do what we call significant risk transfer, so buying a first loss or second loss of a bank portfolio in order to, and we generate double-digit return thanks to that, getting access to a pool of loans that will be very good quality. Another type of deal that we are doing being based on bank disintermediation is also, of course, CRE debt. We have one of the largest CRE debt, so real estate debt franchise, and we are at a time where, and we can talk about real estate, where values have adjusted on real estate, maybe more or less depending on which kind of asset class, which kind of geography, but you are entering the CRE debt market with very low level of, or at least valuations that have adjusted, and a market that normally usually is dominated by banks. In Europe, banks represent 2/3 of the CRE debt market, a little bit less than that in the US, because you have insurance companies, you have the CMBS market that has always been more active, but a market that remains dominated by banks. Banks are off because of everything we know, notably Basel III, but also because of the hits they have taken on real estate. So it's a perfect moment. So on credit, you can do, yes, this banking disintermediation is offering a lot of opportunities. We like the healthcare sector. That's one of our preferred sector. But we invest in healthcare through real estate. We have one, if not the largest, life science franchise in in Europe. So we built and we developed buildings, laboratories in partnership with universities, with medical centers in order to offer the premises needed by all those startups and players in the healthcare sector. That's something within the real estate segment that is performing very well. We have been very active in the medical offices, in hospital, in real estate. We are also investing in the healthcare sector with our infrastructure division, where we have invested in laboratories, for example, that provide diagnosis and tests. And this is also something that is performing very well. We are invested in healthcare in private equity with a strategy that is targeting the markets where you have big populations, so more emerging markets. So we source companies in Europe or in the US, but with that are developing molecule or devices or vaccine that can address the big part of the population. So they will address pregnancy disease, or they will address vision problem, they will address diabetes. And so we distribute and we make the returns thanks to the high volume. So that's also a very strong bet. But all this is supported by this conviction on healthcare. And of course, when we invest in private credit, healthcare is also a very, very strong focus. And there is other trends. Of course, digitalization is one of them. That's a big focus when we invest in data centers, when we invest in fiber. That has been, those sectors have overperformed over the past years and supported by this digitalization trend. So that's the way we look at things. And if because we have talked a lot about private equity and private credit, but if we talk a little bit about real estate, that is the asset class that has probably been on the headlines and not always for the best over the past months. When I look at our portfolio, offices represent less than 30% of the portfolio. And of those offices, they are generally they are European. We have no office exposure in the US. And it's more in the US where offices are under big pressure. But even in Europe, when I look at the rental growth we have generated with the office portfolio, it was 10% last year. So yes, there is issues with offices, notably those that are not well located, but the best assets, well located, continue to attract a lot of tenants and to generate good returns. But if I look at the rest of the portfolio, of our real estate portfolio, we have overweighted over the past year logistic, residential, but also student accommodation, senior living, and all those sectors that benefit from very strong underlying trends, very strong cash flow, a lot of demand. So, yeah, the rental growth overall on the portfolio, on the real estate portfolio, was 10% last year. So I'm not telling you those portfolios are immune from interest rate adjustment, of course, but it's true also for private equity. All the assets that are capital intensive, they have, they can be, and they are affected by the cost of financing that have been multiplied by maybe 3 to 4. But when you can generate cash flow and good cash flow growth, it can compensate or overcompensate for this adjustment. And maybe the difference between private equity probably and real estate is the fact that on real estate, because we have a lot of open-ended vehicles, because those asset classes are also owned by insurance companies that are forced to put those assets at mark-to-market, there is valuations. The hit has been taken within the portfolio. So when we show you a portfolio, this is at values that have adjusted. It's more challenging in private equity that is structured generally more through closed-ended vehicles and where you don't have the same valuation system in the market. So but at the end, the performance cannot be immune from the level of interest rate and the cost of financing.
I'm delighted that you brought up these two things that are so elemental to any form of active investment like all of you do. And I'm curious to know whether there's some agreement among our panelists on, high conviction and megatrends. Isabelle here mentioned healthcare, for example. And, within logistics, of course, there's sort of trade reorientation. We've heard a lot today about the energy transition. We've also heard about artificial intelligence, in fact, just on the preceding panel. Raja and Suyi, do you share any of what you heard from Isabelle in terms of high conviction, and how are you applying it in the investments that you're originating?
Private equity, again, as I said, it's the highest risk and return asset class. Within private equity also, there are different level of risk taking. If you go to the early stage ventures, it's a higher risk and return. Buyout, less so, that you have more predictable cash flows. So private equity players has been very good at navigating, finding the best opportunities to make 2.5 to 3 times money in 5 years. Again, it's a big challenge. So for the last 10 years, we've invested a lot in enterprise software. Yeah? That is a digitization trend that I think we are still in the middle of that. Right? So digitization, I think, it went up to now super speed with the AI as well. There are lots of other infrastructure, whether it's electric generations or the transmissions or data centers, all needed. But also, our business itself should be ready to be able to utilize all of those. So I do see the digitization across the world, whether you're buying a company that's providing vertical or horizontal enterprise software solutions or IT solutions businesses. I just came back from India. Right? So India is one big country where they provide a lot of outsourced IT services. Yes, with the AI development, it could get interrupted, but not all IT services businesses are the same. There are the businesses that are focusing more on migration of your data to the data lakes and helping the companies to be able to implement going cloud or implementing your data analytics as well. So I think there is a digitization, there's one big trend. I do agree also on the healthcare side as well. Private equity, when you look at underlying portfolio companies that we have, these technology and the healthcare services are the 2 biggest proportion of the portfolios. We all know that globally the aging is happening in the developed markets and even some developing countries as well. And the healthcare needs to continue to innovate, and there are players that are doing better and better, and then market share growing, overall market growth. I think that it will continue to be there.
What about you, Raja?
Sure. So I think from our perspective, what we feel really passionate about is really like 2 high conviction themes. One is, as I mentioned, we have chosen to invest most of our private credit in the senior part of the capital structure, but more importantly, with large corporates. And I'll give you an example, which actually just was announced today. We are lending more than $10 billion to a joint venture with Intel Corporation to build one of their semiconductor chip plants in Ireland. And this is a very unique financing because it serves a couple of needs for Intel. They wanted equity treatment, they wanted efficient cost of capital, and a long-term partner. So I think the theme is that a lot of these corporates that used to deal with banks, especially for large financings, they are looking to enter into partnerships with someone like Apollo who can come in, and even with a private credit or a private alternative asset solution, that we are providing them with a solution that's going to take care in the long run, 5, 10, 20-year transactions that we enter into some of these large corporates. We did a multi-billion-dollar deal for AT&T in the US. We did a multi-billion-dollar deal for ADNOC, similar one for Anheuser-Busch in the US. So all of these large corporates and their boards are coming to us and saying that, well, you can solve for X, Y, Z, and you can also invest with us for the next 10, 15 years. And for all these investment-grade companies, we are creating assets for our global wealth clients in the high single digits. Now, that to me sounds really, really attractive. Secondly, I think the other theme is the theme of platforms. And by that, I mean that, Apollo, we have invested $8 billion of our capital to invest in 13 platforms. And these are platforms that generate senior credit every day. You talk about aircraft leasing, lending to planes, trains, automobiles, consumers. And here we are generating, again, top of the capital structure at a very good, attractive return. So I think these are kind of the 2 primary themes that, we are looking to create. And a lot of these goes into, our semi-liquid perpetual products that are really geared for our wealth investments, that you actually get diversity. And a lot of these, what I call top of the capital structure, super safe, large corp credits at a very attractive rate versus the public markets.
I'd like to know a little bit about how geopolitics is affecting your investment decisions. It's pretty hard to ignore geopolitics sitting here in Hong Kong. In some respects, what Roger just told us about the deal that Apollo has done with Intel, in some respects, that is a function of geopolitical trends. Intel is a beneficiary of very generous subsidies from the U.S. government, and that is creating opportunities for Intel to do things with its portfolio of fabs around the world, and by extension, creating an opportunity for Apollo. Isabelle, why don't you tell us, how is geopolitics affecting the way that you look at the investment decisions you're making at AXA, are there things that you are doing because of geopolitical trends and things perhaps that you're also not doing because of geopolitical trends?
When you are looking, I think we are all passionate about private assets. But the reality, I've been in this industry for 30 years, and the reality is that to adjust your portfolio, to make a transaction on private equity can take 6 months, sometimes even more. Even on private debt, it's not, the beauty is that we are not trading on a Bloomberg screen. So
tragically.
we look at Bloomberg. We use Bloomberg a lot because we have to have the reference and the public market reference. But at the end, we are investing in assets that it takes long to transact. It takes long to build those portfolio, and it takes long to shift your portfolio. If I look at our real estate portfolio, it was 2/3 offices and retail 10 years ago. Today, retail has almost disappeared, and offices is below 30. But you have to have the right calls and the right convictions. So you want to go through the cycle. So yes, we know that geopolitics is there. We know that, but I didn't know about COVID. I didn't know about the Ukraine war. I didn't know about what's happening in the Middle East, even if we can predict. And this tension between China and US is also there. We know that it's there, but it can appear here and there. And you know that your investment, your portfolio has to be as immune as possible from all those risks. And so you will avoid, the way to protect from those risks is to avoid some countries that are very tricky. Of course, we have never invested in Russia. We have never invested in China either because we were not so comfortable about our capacity to generate return there. So you have to select countries where you feel comfortable on the long run. And once again, look at the underlying trends, look at what will support your asset, whatever happens, whatever. And I'm happy to say that post-COVID, our investment convictions are exactly the same than they were pre-COVID, because those crises, what they do is they just accelerate those trends. So they are a catalyst, they are an accelerator. And so if you pick the right convictions, if you design the right pathway to adjust your portfolio, you will protect your performance, whatever happens, and even things that are a little bit unpredictable. So that's the way I would look at it. And the other thing is diversification. If you want to protect your portfolio from those risks, you have to diversify within real estate, within infrastructure, within private credit, within private equity. That's the recipe. And so, yes, the convictions and the diversification are the best protection. Now, can we benefit from those geopolitical risks? Yes. Logistics, for example, that's a booming asset class. And yes, we get advantage of the fact that we have a lot of reshoring, a lot of companies that make the decision to change their chain, the supply chain system, and to reshore more and more in Europe or in the US. And that's something that is accelerating, notably the trends on logistics, and allow us to have rental growth on this sector that is also more than double digits. So,
Raja, Suyi, are you leading into anything because of how you see geopolitical trends evolving, or perhaps leaning away from anything? And also, since Isabelle brought it up, how do you feel about China?
Go ahead. Go ahead. I was going first. So I think from our perspective, I think one of the things that Isabelle mentioned is that you really got to make your portfolios all-weather proof. And I think the way we do that is really by having a very value-oriented approach, which is why we go back to one of our tenets. It's like purchase price matters, guys. Don't forget it. It does play a very important role as to how your portfolio returns shape up and migrate. With respect to geopolitics, look, I mean, we take a very pragmatic view in terms of where we can actually conduct business, where we can underwrite assets, where we can call it an edge of what we can do versus being completely at the mercy of policies or other regulatory aspects that we just can't quantify. And sometimes it's not a science, it's a bit of art. So I think we pick our geographies. As an example, I give you for Asia Pacific. I mean, we are open for business in Asia Pacific, but we have certain country focuses: India, Australia, Japan, Korea. clearly are some of the countries that we focus on. Now, China is, in our mind, it's just that the gravity has shifted away from China. And again, that has led to what my earlier comment was. A lot of the liquidity flows has come out of China and found home in public markets, which distorts pricing. But at some point in time, China is going to come back. I can't predict the time. So it's really a question of where are you positioned, where you can actually invest with a certain level of comfort and confidence that you'll have some desired outcomes. And to the extent that those are not possible, or maybe just a moment of time, that you take a step back, but you never kind of walk away, because the opportunity set arises when there are market dislocation, when capital flows leaves the public markets, opportunities arise.
Suyi.
So geopolitics and regulation has become more important areas of diligence, right? And then as an equity investor and private equity investor, we run lots of scenarios. Generally, your return on an investment case doesn't come with your investment base case. So with this uncertainty in geopolitics and regulations, our team needs to run a lot more downside cases and potentially upside cases as well. There are companies that has a strong moat in their own domestic market. They may benefit. Yeah. Having said that, we do not rely on regulatory benefits as in the base case, as Isabelle kind of alluded as well. This is a long-term asset class. Yeah, private equity investments, if you invest into the funds, it's a 12 years asset class. Direct investments, anywhere 5 years to the 7 years that you need to hold. We have seen government changing generally over the time in most of the countries, and tax policies changing and all of those. So do we take into account the IRA when we do the base case returns? No, actually we look at it as a gravy on top. Yeah? There are cases of this, we call the stroke of a pen risk. Stroke of a pen, we do not like those assets. There are industries that's sensitive, that on top of the national security agenda of many countries around the world, we do not like those industries. And then when you think about this upside and downside and focus on the fan of outcome that you can get in any given investments, certain countries and markets, it's challenging to make the investment case.
Could you give us a couple of examples of stroke of the pen, for example, or that last category that you just outlined about sort of sensitive areas?
So there are some of the industries that were in the past that you would manufacture out of China, you would export out to the US. You may not want to invest in the themes because the US government believes some of the industries like semiconductor is the national security areas. Not the private equity invest into semiconductor. That is actually very asset-intensive businesses, and it's hard to make, again, 2.5 to 3 times money in 5 years. So that's one of the examples. There are many other things. I mean, we talked about healthcare. Healthcare is highly regulated industry. Financial services is highly regulated industry. Telecom is highly regulated industry. Some of the niche businesses that you look at it, once the government changes the policies, your economics may dramatically change. And then we do not like to own those assets. Yeah.
And finally, and we don't have much time, regrettably, you've spent a good part of your career here in Asia, in fact, once upon a time based in Hong Kong, if I'm not mistaken. How is CPPIB thinking about China right now?
I opened our Hong Kong office. I'm our first international employee that CPP Investments ever hired. I've been based out of Hong Kong for 14 years. I've been here for many years as well. China is, we have our Hong Kong office. We have more than 100 people on the ground here as well, investing across Asia Pacific. China is one of the largest economies in the world. We do believe as a large global investor, it is important to understand that market. If you're not investing directly into market, which we do continue to invest in that market, but not understanding that part of the world will have impact on understanding the rest of the world, how the business is going to pan out and economics is going to pan out. So that's how we look at it.
Very good. Ladies and gentlemen, I could continue talking to this panel for quite a bit longer, and I suspect you could continue listening to them, but sadly, everything must come to an end. And that does conclude our plenary program for today.